The IRS has made it clear that they intend to pursue crypto reporting. In 2019, they began distributing letters to users they believed were underreporting their taxes after gaining access to the client databases of multiple US crypto exchanges, including Coinbase. Next, at the year's close in 2024, the Internal Revenue Service issued updated regulations on crypto accounting and reporting. The imminent arrival of official infrastructure and regulation is assured in the next years has been made abundantly obvious by this. Scary? Unless you're trying to conceal anything. In all likelihood, this presents a chance for more widespread acceptance, enhanced credibility, and eventually increased pricing. Perhaps we all grow slightly wealthier then. However, if you ever believed you could conceal your cryptocurrency from the IRS, that time is over. On the other hand, if you aren't careful with your cryptocurrency taxes, you run the risk of unintentionally paying too much or becoming a target. Let me tell you 5 things that the taxman isn't telling you, even though he's not shy about informing us he's coming. Things that can aid you in evading tax audits and save a ton of money as you build your fortune through trading. I am Anthony Price, CPA, for the benefit of anyone tuning in for the first time. In addition to owning a CPA practice that assists hundreds of crypto investors and entrepreneurs, I also serve as the resident CPA inside Altcoin Pro, a community that teaches members how to create, grow, and safeguard their cryptocurrency holdings through sound financial and tax planning. To ensure a successful tax return, enroll in our Crypto Tax Mastery course. The video's description includes a link where you may schedule a free call with my team or myself. Okay then, let's begin. One hidden potential is a lack of clarity. We still don't have complete information on how crypto should be taxed from the IRS. Furthermore, as a result of this haziness, opportunities arise for astute investors. For example, you can lawfully alter your Bitcoin cost basis technique provided you maintain proper accounting records. Your cryptocurrency can now be taxed using the FIFO, first in, first out, or specific identification, SI approach. You can make good use of HIFO, highest in first out, or LIFO, last in first out, with precise identification. Give me an example. If you purchased 3 Bitcoins for $20,000, $40,000, and $60,000, and sold one coin for $65,000, you would realize a gain of $45,000 under FIFO, but only $5,000 under HIFO because your cost base is $60,000. Assuming accurate records are kept, that constitutes a huge tax disparity. Another murky issue is staking. If you have constructive receipt, which means you have complete control and access to use or sell the tokens, then it's likely taxable income when received. Since this is dependent on the protocol and the distribution of incentives, it is possible that income can be postponed. Also, the wash sale regulations aren't applicable, just yet, because cryptocurrency is still considered property. So, you won't have to wait the standard 30 days to repurchase a coin after selling it at a loss. Now, this might change, and a lot of tax experts think the IRS will soon expand wash sale laws to include digital assets. In order to play it safe, I suggest waiting a few days and maybe keeping track of the investment-related rationale behind the buyback. If the Internal Revenue Service were to attempt to dispute that, it would demonstrate that it wasn't only a tax maneuver. Next, you won't believe how sophisticated the IRS's crypto tracking system is. Their crypto tracking is pretty similar to ours, except they use far more data and analytics backed by AI. Thus, the Internal Revenue Service does not develop its own crypto accounting system. Instead, they leverage the platforms used by the FBI and large exchanges, such as Chainalysis, Palantir, and TRM Labs, to license advanced blockchain analytics tools. These programs create a graphical network diagram by connecting wallet addresses, exchanges, and transactions. Thus, even if you believe you are completely anonymous, all information pertaining to your Know Your Customer (KYC) processes with US exchanges or on-ramps to DEXs can be traced back to you. Not to mention that the government already has access to all of your KYC documents from US exchanges. Additionally, the link between your exchange and private wallet remains on chain indefinitely if you have ever exchanged cryptocurrency between the two. It can be traced. Bet on the opposite. Uh, They're keeping an eye out for big unreported wallet transfers, mismatched 1099 documents, and other questionable activities using AI-powered dashboards. Therefore, they can access the transaction graph during the audit without requiring your wallet password. No matter what, you will be discovered. I can help you get ready though. Thirdly, there are fundamental tactics that significantly impact outcomes. A few easy tax tactics, such as timing, can significantly alter your tax liability. Oh, and what about managing brackets? Final sales in a large quantity just before the next tax bracket begin. Subsequent year, repeat the process. One alternative is to hold off on realizing gains until a year with reduced income, and vice versa for losses. Your lifetime tax rate will be reduced in this manner. Having that as low as possible is really desirable. Having said that, what about savings plans? These tactics for minimizing taxes and protecting assets are so underappreciated, in my opinion, because they are so simple but so successful. Utilize these to acquire cryptocurrency. But now we can talk about subtlety. At this time, you are unable to directly purchase cryptocurrency using a conventional IRA or 401k through a typical brokerage such as Fidelity or Vanguard. Crypto exchange traded funds, ETFs, like Bitcoin and Ethereum, are your exclusive access point. Price exposure, but not custody, is what you're getting. You require a self-directed individual retirement account, IRA, or solo 401k to hold cryptocurrency directly, stake, mine, or yield farm within your retirement benefits. Here, you can hold cryptocurrency legitimately through an LLC or custodian, exercising complete control over your wallets and investing decisions. As for crypto, Roth is typically preferable than traditional over the long run. All future growth can be completely tax-free after you pay the tax once. It would be more preferable to pay taxes on the lesser contribution now, rather than the substantially higher dividend later, if you anticipate Ripple to blow out its profits. Look into I Trust Capital or another comparable self-directed custodian if you're interested in learning more about self-directed accounts. The description includes links. What about the company's overall plan? You can claim common expenses like equipment, classes, and travel as a business expense if you're in the mining, teaching, or content creation industries. If it's not a legitimate business and not a pastime, you might not be able to claim your losses. Moving on to strategies for overseas residency is the next step. Of course, not everyone will benefit from these, but when they do, they truly change the game. This is similar to state residency arbitrage. Reason being, you might save as much as 13% on your state taxes if you relocated from California to either Nevada or Florida. You leave New York in the same vein. What about optimizing taxes based on territory? Reason being, if you're taxed heavily in your home state, relocating to Puerto Rico could result in a total tax savings of more than 50% on both regular and short-term capital gains. Simply put, dividends are exempt from taxation in Puerto Rico, whereas corporations are subject to a 4% tax rate under Act 60. In order to be eligible, you need to move legally. To become a tax resident of Puerto Rico, you must purchase or lease a property, relocate all of your personal belongings, join a local gym, get a driver's license, change your address, and spend at least 183 days a year in the island. Having said that, there is some leeway. If it works for you, you may spend about 5 months in PR, 3 in the US, and 4 abroad. Foreign trusts are the next entity to be discussed. Although these are costly and complicated, they offer excellent asset protection and the ability to postpone paying taxes on income until it is delivered to you, which can be a significant benefit. Yet compliance is harsh. It's likely that you'll also have to file FBAR FATCR reports in addition to Forms 3520 and 3520A. Therefore, this tactic is reserved for the very wealthy and those capable of carrying it out with meticulous precision. You should expect at least 5-figure costs. Please grasp this now. Constantly, the IRS will state that they are enhancing enforcement and constructing new monitoring technologies. They won't disclose you their secret source, the ambiguity in their own regulations, or any lawful ways to save or postpone paying taxes. They won't even scratch the surface of the advanced strategies to completely postpone or even avoid paying taxes on. You won't hear that from anyone other than a seasoned crypto CPA. Put this information to good use and prosper. Reconvey to you in the subsequent video.